Let me ask you something very carefully. What if the $70,000 bounce wasn't strength? What if it was just a setup? Because right now, behind the headlines about Nvidia earnings, behind the Jane Street chatter, behind the temporary risk-on sentiment, Bitcoin's 3-day chart is quietly flashing the same signal that preceded a brutal 50% crash in 2022. And this time, the structure looks disturbingly similar. Stay with me, because what we're about to break down is not fear-mongering, it's structure, data, and market mechanics. Bitcoin pushed towards $70,000. For a brief moment, optimism returned. Social media flipped bullish, traders started talking about 100K again, some even revived 150K targets. But here's the problem. The rally didn't hold. Price tapped the level and faded almost immediately. That hesitation matters, because when strong markets break key resistance, they expand, they accelerate, they don't stall. And right now, the bigger technical picture is becoming impossible to ignore. On the 3-day time frame, Bitcoin is approaching what's known as a death cross. Now let's slow this down. A death cross forms when the 50-period exponential moving average crosses below the 200-period exponential moving average. To traditional technical traders, this is not just a random crossover, it represents a structural shift in momentum from expansion to contraction. The last time Bitcoin printed this signal on the 3-day chart was in 2022, and what followed? Roughly a 50% decline. That doesn't mean it must happen again, but markets move in patterns more often than people are comfortable admitting. And when similar structures form under similar macro conditions, probabilities matter. If this death cross confirms, it increases the odds that the current correction is not finished. Now add another layer. A bear pennant formation has been developing. A bear pennant is a continuation pattern. It forms after a sharp drop, followed by consolidation in a tightening range. It represents a temporary pause, not a reversal. If this structure resolves to the downside, the measured move projects significantly lower prices. And when you combine a death cross with a bear pennant, you're not looking at random noise, you're looking at stacked bearish signals. If the 2022 fractal repeats, and this is strictly conditional, Bitcoin could revisit the $30,000 to $35,000 range by the end of 2026. That would represent roughly another 50% downside from recent highs. Now, before panic sets in, let's bring balance. Markets are not just charts, they're narratives. And recently, two major narratives attempted to shift sentiment. First, Nvidia earnings. Nvidia reported strong numbers, not catastrophic, not euphoric, just strong. Risk assets initially responded positively, but by the next morning, U.S. futures were lower. That tells you something important. The market didn't see the earnings as transformative. Bitcoin mirrored that hesitation. It rallied into $70,000 and then pulled back. That behavior is often associated with what traders call a bear trap. A headline forces short sellers to cover. Price spikes quickly. Momentum traders jump in. But when fresh demand doesn't follow through, price fades. Now, let's address the second narrative, Jane Street. There's growing chatter that Jane Street, the quantitative trading firm, has been suppressing Bitcoin's upside through derivatives activity and liquidity provision strategies. Some bulls argue that if that pressure eases, Bitcoin could explode higher. But here's the uncomfortable truth. There is no verified structural evidence proving that Jane Street alone caused Bitcoin's 50% drawdown. It's easy to assign blame to a large institution. It's harder to accept broader market mechanics. Liquidity cycles, leverage unwinds, macro tightening, risk repricing. These forces matter more than a single firm.
And if you look at on-chain data, the picture gets even more nuanced. CryptoQuant's short-term holder profit and loss to exchanges metric has remained net negative since January 26th. What does that mean? It means short-term holders, recent buyers, have been sending coins to exchanges at a loss. That behavior is not accumulation. That behavior is stress. There were two sharp downside jolts recently, around February 5th and February 21st. Both times, Bitcoin dropped roughly $8,000. Both times, the selling was absorbed. But here's the critical detail.
The metric never flipped back to sustained positive territory. In plain English, each bounce is being used as an exit opportunity, not as a long-term conviction entry. That changes how you interpret rallies. Instead of seeing strength, you may be witnessing distribution. And this is where psychology becomes critical. In strong bull markets, dips get bought aggressively. In weak markets, pumps get sold. Right now, the data suggests the latter dynamic is dominating. Now let's zoom out further. Macro conditions in 2026 are not identical to 2021. Liquidity is tighter. Central banks remain cautious. Risk assets are more sensitive to earnings and economic data. Bitcoin no longer trades in isolation. It trades as part of a global risk complex. That means equity weakness can spill over. Dollar strength can pressure crypto. Bond yields matter. This interconnectedness increases volatility. But here's something equally important. A 50% correction, if it happens, does not invalidate Bitcoin long-term. Historically, Bitcoin has experienced multiple 50% drawdowns, even inside larger bull cycles. The question isn't whether volatility exists. The question is whether structure supports recovery. And right now, the structure is conflicted. Long-term adoption metrics remain intact. Institutional access has expanded. Spot ETF infrastructure exists, but short-term technicals are fragile. Momentum is weak, and sentiment is oscillating between hope and frustration. When markets are this divided, sharp moves tend to follow. Either the death cross confirms and downside accelerates, or bulls reclaim momentum decisively above major resistance, invalidating the bearish setup. There is very little room for sideways drift. Compression leads to expansion. Now here's what would change the outlook. First, the 3-day death cross fails to confirm. Second, Bitcoin reclaims $70,000 and holds it as support, not resistance. Third, short-term holder profit metrics turn sustainably positive. Fourth, volume expands on green candles, not red ones. Without those signals, caution remains justified. This isn't about doom, it's about probability. Markets reward preparation, not emotion. And right now, preparation means acknowledging that a repeat of 2022-style volatility is possible. Not guaranteed, possible. If Bitcoin does revisit $30,000 to $35,000, it would shock late buyers. It would generate headlines. It would likely trigger capitulation narratives. But historically, maximum opportunity emerges when conviction is lowest. For now, though, the burden of proof rests with the bulls. They must show strength, not just short squeezes. They must show sustained demand, not reactionary spikes. Until then, the 50% crash scenario remains on the table, quietly, structurally, mathematically. And markets don't care about hope. They respond to liquidity, structure, and positioning. So the real question isn't, will Bitcoin crash? The real question is, if it does, will you recognize it as risk or as opportunity? This is Bitcoin Legacy. Stay sharp, stay informed, and never trade narratives without verifying structure. Because in this market, what you don't see,
usually matters most.